Hey everybody, it's Will at VIP Mortgage, and it's time for your local lender update. Today we're seeing a significant rebound on the bond market, and that has to do a lot with consumer sentiment. The bond market has been reacting somewhat emotionally to what's going on in Iran. Not trying to discount some of the reasons behind that, but when you look at it, it's really driven by the headlines, and a lot of the headlines are not catching what's really going on in the Middle East right now. For example, people are acting like the Straits of Hormuz are completely shut down and there's no traffic through there, which is just not actually what's happening. And so you see these swings. We've seen a couple of smaller rebound days, again, based on headlines where somebody comes out and says something that is interpreted as being good and maybe the crisis is coming to an end. All that kind of stuff. So we're seeing much bigger moves on the bond market than we're used to seeing on a daily basis, and today is no exception. Today's rebound again is based on consumer sentiment, because consumer sentiment is at the lowest level it's been in a long time. 70% of the American economy is consumer spending, and so if people are feeling like they shouldn't spend money, they probably won't, which would lead us into a recession. And last week, some of the negative days on the bond market were really driven by the idea that the Fed might actually hike rates before the end of the year, which is the opposite direction they've been going, and the market was getting nervous about that. Of course, bond market's based on expectations, so they try to adjust their pricing before there's any kind of a rate change, and those negative moves were driven by that idea. However, if there is a recession coming because consumer sentiment has slowed down, raising rates would be the exact wrong move. It's like the bond market is waking up and realizing that, yes, oil prices may be higher. Yes, things may get a little more expensive at the store based on inflation. And all of that can be true, and we could still stay neutral or cut rates because the economy as a whole has slowed down. Now, I'm not saying that a recession would be a good thing, and I'm not rooting for harder economic times, but I would point out that we are way overdue for a recession based on the normal cycles of recession. If you take out the correction during COVID, that was very steep and very sharp, and we recovered very fast from it. It wasn't long enough to be a recession. If you take that out, we're 5 or 6 years overdue for a recession because the economy runs sort of in cycles. So while it may not be a great thing in the near term, it could be good for the market as a whole if we do see some cooler economic activity. And if you're interested primarily in interest rates and buying a house and the cost of home ownership, that could be a silver lining for you in the next 9 to 10 months. If there's anything I can do for you, or if you'd like even more detail, give me a call, 719-232-7553.